Are the markets on the brink of another upheaval? With the 2024 elections approaching, tensions rise and economic stakes climb.
Absolutely. Today we're diving into critical analyses from financial experts covering Bitcoin's volatile existence to the geopolitics affecting the South China Sea.
Welcome to Financial Insights in Minutes, where we're all about time-saving summaries of the financial hot topics that impact your investments.
In today's episode, we'll summarize top analyses from Hugh Hendry, FX evolution, and industry leaders discussing pivotal market movements.
Stay tuned as we cover everything from emergency Fed cuts to the implications of global inflation. Diving into today's discussion, what's the latest on market shocks and central bank policies that have traders rattled? Hugh Hendry, the sharp mind behind the Asset Capitalist podcast, joins us to dissect these crucial topics.
Absolutely. Hugh has a knack for connecting the dots between volatility in the market and Fed policy. His unique insights promise to shed light on what might lie ahead.
What's the core message from Hugh's insights?
Hugh emphasizes that all assets are overvalued, causing susceptibility to shocks, especially if currencies like the yen continue to weaken, leading to a depressed labor pool.
Let's dive into the key points. First up, how are market conditions reacting?
Hugh bluntly states that everything is overvalued. A drop could occur if currencies like the yen devalue further, leading to more significant market shocks.
What impacts are we seeing from Fed policies?
Hugh predicts that rate cuts are looming, which may lead to a temporary market rally. However, he warns this could indicate deeper systemic problems brewing underneath.
And what's the story with the yen?
Hugh emphasizes that further weakness in the yen could lead to increased volatility not just in Japan but globally, causing widespread economic repercussions.
So, what does Hugh predict for the economy moving forward?
He sees significant unrest on the horizon. As stimulus measures kick in, we could spiral into deeper inflation rather than the expected economic recovery, which could trigger market corrections.
Could we see more interest rate cuts in the near future?
Yes, Hugh believes the Fed will cut rates faster than anticipated, which may lead to short-term stability, but masks underlying economic problems.
So what's the bottom line from Hugh's analysis?
Hugh concludes that we're in a precarious situation with overvalued markets and currency weaknesses. He warns significant corrections may be perilously close as the Fed navigates its policies.
As we close, what do you think? Do you agree with Hugh's assessment of the market?
Comment below your thoughts. Stay tuned for our next segment where we dive deeper into tech market trends.
Let's dive right in. Today's hot topic focuses on market signals and trends as we navigate through the historically tricky month of September.
That's right. With the S&P 500 consolidating and the Dow hitting an all-time high, the underlying market movements could tell us a lot about what's next. Let's break it down.
So what's the crux of this analysis?
The core thesis is that although September has a reputation for being a downer for investors, current market signals indicate possible improvement, especially beneath the surface.
Let's get the scoop on those history lessons.
September usually brings declines, but interestingly, election years might sway the market towards rallies. That's something to keep an eye on.
What's brewing in terms of market breadth?
Recent metrics show an improving breadth, hinting at a potentially promising rally ahead, even amidst market swings.
Let's talk about rate cuts and their impact.
Well, rate cuts are a double-edged sword. They could bring both volatility and opportunities. Timing will be crucial as we move forward.
What does the crystal ball say about market predictions?
Expecting a potential rally as more sectors, particularly small and mid-caps, could start outperforming.
And what about volatility?
Get ready for a wild ride. September is expected to show volatility, so being strategic is key.
In summary, what should viewers take away from this?
The overall takeaway is to stay informed, be aware of upcoming rate cuts, and approach September with an adaptive strategy. The stage is set for both challenges and opportunities.
What's your game plan for September?
Share your thoughts in the comments. Your insights could spark new ideas for our community.
Let's dive right in. What's today's hot topic? It's all about the recent GDP numbers and their startling implications for the economy.
Absolutely. The GDP figures might seem rosy on the surface, but there's much more lurking beneath. And today we've got Jeff Snyder, an expert in economic cycles, to shed some light on this.
So what's the core thesis here?
The main takeaway is that while GDP shows growth, it's misleading. The GDI, gross domestic income, provides a more accurate picture of economic health, exposing troubling signs beneath the positive GDP surface.
Let's break down the first key point. How do GDP and GDI stack up against each other?
GDP appears strong at nearly 3%, yet GDI reveals a decline of over 1%. This disparity is significant, confirming the economy isn't as robust as the GDP suggests.
Moving on to consumer confidence. What's the vibe?
It's shaky. Consumers are feeling the pinch, evident from companies like Dollar General, which saw a stock drop of 25% due to declining sales trends among low and middle-income earners.
What are the warning signs we should be aware of?
The alarm bells are ringing. A steepening yield curve historically signals recession, and past divergences between GDP and public sentiment tell us this isn't just a passing phase.
So looking ahead, what are the predictions Jeff lays out?
He warns of an impending recession as current economic data suggests consumers may further cut back on spending due to inflation. It's a precarious balancing act.
To wrap it all up, what's the big takeaway here?
The discrepancy between GDP and GDI is crucial. While GDP looks promising, GDI signals are telling a different story of economic downturns. It's time to heed the warnings.
And what should viewers take away regarding economic discussions?
Understanding these figures is vital. It's about more than just numbers, it shapes real-world decisions and strategies. Let's keep the conversation going.
Time to navigate through the farmland landscape. Today, we've got returning guest Craig Wichner, Managing Director of Farmland LP, here to shed light on the shifting tides in farmland investing amid growing opportunities.
Indeed, Craig brings deep expertise in sustainable agriculture and has valuable insights into how the current market is favoring smart investors. Let's dive deeper into the trends shaping the farmland sector.
What's the core thesis of this farmland investing update?
The main takeaway is that farmland is currently a buyer's market. With institutional investors facing pressure to sell, high-quality land is becoming available at declining prices, creating unique opportunities.
Let's break down the market. What do we need to know?
Farmland represents over $3.8 trillion in value in the U.S. Interestingly, institutional ownership is only at 2%, hinting at low competition and plenty of potential for savvy investors.
What about price trends in the market?
The demand for premium crops is on the rise, particularly for organic produce. However, several almond growers are facing price drops due to oversupply, creating opportunities for buyers.
What strategies should investors consider?
Investors should diversify across different crops to minimize risks. Converting farmland to organic can boost profits, and investing in water rights is crucial, especially given changing climate patterns.
So, what are Craig's predictions for the future?
Institutional sellers will likely remain under pressure, increasing market opportunities. Plus, growing consumer preference for organic products ensures sustained price increases, while climate change will continue to shape crop viability.
Anything else on the investment horizon we should keep an eye out for?
Absolutely. As institutional investors become more interested, we could see values rise across the board. Expect new funds to emerge in sustainable agriculture alongside tech-driven innovations enhancing yields.
In summary, what's the big picture here?
Investing in farmland offers an exciting opportunity, especially as market dynamics shift in favor of sustainable practices and meet rising consumer demands. It's definitely a space to watch.
Lastly, what should potential investors be considering to participate in this market?
Exploring avenues through funds like Farmland LP or participating in webinars to learn more is a great first step. Market conditions are ripe for investment, seem straightforward, but research is essential.
Time to navigate through these waters. Today, we're diving into the massive economic impact of tensions in the South China Sea.
Exactly, it's a potential powder keg for global supply chains and economic stability.
What's the crux of the issue here?
The core thesis is that disruptions in the South China Sea could paralyze global trade, leading to overwhelming inflation and a potential economic crisis.
First up, how critical is this trade route?
It's incredibly vital. With 44% of maritime traffic flowing through it, any conflict here would disrupt everything from your electronics to oil supplies.
And what about the geopolitical tensions?
Tensions are high. Japan now seeks mutual defense with the Philippines to combat China's influence, shifting their defense posture significantly.
Supply chains seem vulnerable too.
Absolutely. If the South China Sea is compromised, we'll see a catastrophic hit, especially in tech, where semiconductors are crucial.
What's the prediction on inflation?
It could surge. We're looking at overwhelming inflation if major supply chains are interrupted, impacting consumers globally.
And rare earth minerals.
China's grip on this market complicates the matter. Their control stifles alternatives, leading to prolonged dependency and risk.
What are the predictions if conflict escalates?
Massive global inflation. Prices for everyday goods could double, and we could witness historically high inflation rates.
And how about supply chains?
We could be facing a real crisis. Critical goods might vanish from shelves, and factories could shut down due to a lack of resources.
So, wrapping it up, what do we take away from this?
We need proactive strategies. Establishing alternative supply chains is crucial to mitigate risks from threats in the South China Sea.
What could the future hold?
Continued tensions might reshape global economic dynamics. It's a ticking time bomb, and we need to stay aware.
In today's video, we explored alert signals from top analysts about potential for market instability and asset volatility.
Analysts like Hugh Hendry and Jeff Snyder painted contrasting views with significant implications for traders and investors alike.
As geopolitical tensions rise, our understanding of market dynamics is crucial. Let's keep the conversation alive.
Thank you for joining us on this financial journey. Catch relevant updates on Financial Insights.
Remember to like and subscribe. Thanks for watching Financial Insights in Minutes for September 1st, 2024. If you found this time-saving content useful and want to support the channel, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.